We have talked about a lot of concepts, liquidity, change of trends, how to use the trend line, and a lot of them. So I'm pretty sure now you are, you know, working hard on them so that you don't get to forget. You understand? It's only your hard work that will put these things in your head, put them in your retentive memories. You understand? So right now we're going to talk about the HMC content. You understand? Content like what is inside the whole thing. Now we did piece like we did them step by step. We did one, we did the other one, we did the other one. Trend line, liquidity. We did multi-time frame. We did. So this one is about what is content. We're going to talk about this content is going to talk about patterns. Then it's going to talk about order blocks. So this is just like that is the main content of our strategy. The patterns, the price pattern, the price channels, and then order blocks, which is our primary entry trigger. So it said introduction. The HMC is a trading system or strategy that is developed to aid traders with small capital or small trading account manage properly their funds and scale as high as they want, like as possible. You understand? You already know that it's a combination of Falcon and the other block, which is from the smart money. If you are in the community, you already know the how effective the whole thing is. Then it says reading the market direction. Already we spoke about reading the directions using the trend line, even on the multiple time frame analysis, the multiple time frame video. You see that we talked about reading the market structure from there, which we use the Falcon strategy to read the structures. Then we're talking about flags. Here we're going to talk about patterns. Those patterns that we talked about on the multiple time frame analysis, like names that are given to them. Names that are given to them. You see here it said, pretty sure by now you can tell what the market trend is. If not, refer to one of the videos talking about market structure so you can understand what the trend is. So the multi-time frame analysis talked about the price patterns and channels and the structures. If it's a descending one, ascending one, if it's a vertical one, they are all there. But here we're going to talk a little more about them, like a recap, before we go to the other block, which is the only content that we haven't spoken about. Flag pattern is a combination. It's a continuation chart pattern named due to the similarity of a flag and a pole. Understand? It looks like a flag and its pole. Like when you hold a country flag or any kind of flag, it has a pole, then it has a flag itself. So you can see the structure right there. That's how it is. When you have an impulse, then the correction before an impulse. After an impulse, the initial impulse is the flag pole. Then the correction forms the flag. The correction forms the flag itself. These patterns, when they are spotted, they are mostly continuation patterns. After the impulse continuation correction, then it continues to the upside. Go to these are very simple ones. We already spoke about channel, so this won't be a difficult thing for you. If you go to market structure, I think is the first part of it. We also spoke about the nature of the market. It moves in what impulse, correction, impulse. So those corrections are what you put into the patterns that cause. Those corrections are the ones you put into the patterns. Then the impulses are the poles. The next one is the double top and double bottom. When we spoke about liquidity, we talked about this more. Now this illustration here is the normal or the regular traders illustration, where they take their entries and where they take their stop, neckline, break of neckline. The stop is after the neckline, all of that. But as you trading the HMC, you know now that it's not supposed to be like that. It's not supposed to be, you're not supposed to take the entries like that. You're supposed to take the entry after the sweep of the liquidity. If you don't know yet, go back to the liquidity video and recap on it. Then he said, this is an ascending pattern or descending pattern, ascending or descending patterns. He said, this is a reversal chart pattern that is formed in the direction of the initial price impulse. Like the place the price impulse to, like you see the price run down impulsively. This pattern is it's a pattern that is formed with the same direction. The impulse was downward, but still the pattern is still downward. That means it's a descending pattern. This one is upward. The impulse is upward, and then the correction is going in the same direction, though without momentum. So it is an ascending pattern, and it's said to be a reversal pattern because when the initial impulse tells you that that particular direction has momentum, has the strength, but now it is kind of like back and forth in that same direction. That means that direction is losing momentum. So when you see this kind of patterns in the market, it's signaling a reversal, either to the upside, from the downside, or to the downside from the upside. If you read more, you get to understand. He said the expanding patterns. Expanding patterns are chart patterns that form successive highs and lows. Successive highs. After a high, you have a low. They are all successive. They don't. This there's no. They are all. Normal trend is supposed to be higher highs and lower lows, and higher lows, then lower lows and lower highs. But this one is higher high, lower low, higher high, lower low. You see the way it is successively higher high, lower low, higher high, lower low. That's how it is. This is like basics, so most of you understand it. If you don't, when we go on Zoom, you can ask me and then I'll explain more. It's a head and shoulders. The head and shoulders, this is the literal way almost everybody trades it, right? Head and shoulder. When you get the head and shoulder pattern, then you take the entry at the break of the neckline. Go back to the liquidity video, you get to understand how to trade this better instead of taking the neckline like the regular traders do. You understand? Then he said those are the chart patterns considered in the community, which we have implemented into the concept. Please go on your trading chart and try to identify these patterns as many as you can. The more time you spend on the chart, the more consistency you build. You understand? The more time you spend, the more consistency you build. You have to always remember that. He says you should refer to Trading Strategy Part 1 to get the details, how to use these patterns. If you go to the liquidity video, I think that is the Trading Strategy Part 1, you get to understand them. Then during the webinars, you get to interact with us for more. We did mention in the introduction that the concept is a combination of two. The second system, which is very important one, which is what we're going to focus on with this, we're going to focus on is the order block. You understand? The order block is entry, is what we use for the entries. This is used for a more defined and refined entry. You understand? For proper stops and proper target. It's a order block entries are time saving and very precise. Using this entry type, a trader do not have to stay on the chart waiting for market to hit a certain price before executing a trade. That means you can easily set limits. That's what it's trying to say. You don't have to, when you know that, when you can spot the valid order block, you don't have to be on the chart for it to come to that place before you get in. After the market hit your point of interest, do what it's doing, and then you have spotted another block, you just have to set limit orders and then you leave. You don't have to stay on the chart. Then it's the order blocks. Order blocks are candles where market makers, the banks or institution, have placed their position. This is where the men who have a lot of money in the market place their orders. Generally, the market returns to those candles. They are never violated if it is a real order block. If the order block is valid, it's never violated unless you didn't filter it well for it to be a valid one. If you filter it very well to be a valid one with all confirmations, it never get invalidated. It never get violated. They always respect it. They say they are also called the supply and the demand. Supply and demand zones. They are also called supply and demand. Order blocks are also called supply and demand. Then there are two types of order block: the bullish order block and the bearish one. The bullish one is the demand zone, the ones that causes a rapid move to the upside. Then the bearish one is the supply, the one that causes rapid move to the downside. Bullish order block. The bullish order block is the last bearish candle before the bullish movement that breaks structure higher. The bullish order block is the last bearish candle. You understand? You can see the illustration right here. It's the last bearish candle. The bullish order block is the last bearish candle that broke the structure. It represents a high probability of holding the price when the price returns to it. So after breaking the structure higher, it has a high probability of holding price. Like it has a high probability of holding price means holding the price for it to launch back again to the upside, taking price to the upside when it comes back to it. That's what that means, like holding price. So it's the last bearish candle before a break of structure, before a break of a previous high, or before the market creates another high. It's the last bearish candle that caused the rapid movement before the market creates another high. This is like another block. This is another block. This is a bullish order block. It's the last bearish candle before the break of structure that created another high. You go on the chart and you get to see them practically. So when you are trading with the order blocks, you see the close or the highest point of the candle is where you put your entry. Then the lowest point of it is where you put your stop loss. So that when the market comes back to tap into it, you get tagged into the trade and the stop loss is below. This is what I meant by it has a precise entry and then time saving. Now the market broke this structure, right? When the market was around here, already you know that this is the other block that originated the break of structure. So you just set your limit at the highest point or maybe the close of it and then your stop loss below. Then you just walk away. If it is a valid order block and it was well filtered, it will tag you in and then you make the profit. It will go in the direction as predicted. Then the next one or the last one is the bearish order block. The bearish order block is the last bullish candle before the bearish movement that broke the structure lower. You know, the market is always either upside or downside, so it's just like an opposite of it. You see that the market is just two ways. That's why if you make a little mistake, you lose. It's either going up or coming down. So if you press for the market to go up and then it's coming down, there's no other way, there's no third option. If you press for the market to go down and then it's going up against you, there's no third option as well. So you have to be very sure before picking from the two. The bearish order block is the last bullish candle before the structure before the movement that breaks structure lower. The last bearish candle. The bullish one is the last bearish candle. The bearish one is the last bullish candle. So this is it, just like this place. The last bullish candle that broke this structure to the downside. Breaking structure means breaking the previous low. For the bullish one, breaking structure means breaking the previous high. These are rules for a valid order block. First, okay, let's go through the rules before we go to the chart. It says rules for a valid order block. It said not just every opposite candle seen before a move that breaks a structure is a valid order block. Some are just market traps and illusions. Like sometimes market just create those kind of candles there so that traders will think that is it. There's one of the episodes we spoke about inducement, right? Inducement, this is what it is. Inducement is just when the market creates an order block looking candle that is not an order block, because few traders or traders that don't really know the order block, they'll take it as another block, and then when you get to that kind of when you put your limits on that kind of trade, when you enter the trade with that kind of order block, you definitely be swept. You'll be swept into the liquidity. It says there are illusions to get traders caught at the wrong side of the market. So below are things you should look at for a valid order block. There must be a liquidity sweep before the order block. There must be a liquidity sweep. If there is no liquidity in the market, like if you have gone through the liquidity video, we explained that if there's no liquidity in the market, you can't make profit from the market because somebody has to lose before somebody else can make the money. As the market is a zero sum, somebody has to lose this money so that somebody else can make that money. So there must be a liquidity sweep. Stop losses should be grabbed before the order block you are looking at is termed valid. The second thing is there must be a break of structure. It's a previous high or a previous low. Now when the candle that
It's
you
9 o'clock.
when the candle that you pick out to be your order block launches and break, when the candle that you pick out to be your order block have a launch after it, the launch that happens, you have to break a structure either upward or downward before you can tag that particular candle as another block. When I go to the chart, you begin to understand there must be a break of structure, which is a previous high or a previous low, before your order block candle is valid. If the order block candle is too large and not suiting your risk management, refine to a much smaller time frame. Yeah, there are some time that the order block candle is very very big. Setting your order at the close of it and then the other one at the low or the high of it, like setting your stop loss and take profit using that particular candle can take you a lot of money if you are wrong, because the order block is too big. So each order block you use should suit your risk management. If you are setting to lose 1% in the market, make sure that the order block you are using is not violating that rule. Some candles are very big that it can even take 2% of your account or even more. So you have to refine such kind of order block to a later time frame to shorten the candle. Number 4, it says the order block should have imbalance and not mitigated. Mitigation means tapped into. They shouldn't touch it. Like no wick should be in it. No candle should have mitigated it before you are looking to take it as another block. It should be imbalanced. Balance is, I will explain when I get to the chart. It's in case of multiple OBs, look out for one that adhere to all of these rules. In case you have multiple other block, like sometimes you see other block here, other block there, other block there on the same impulse. You understand? So you have to look for the ones that adhere to these rules we just read out for you to call it another block. Let's go to the chart to look at other blocks. Now we said the bullish order block is the last bearish candle before the bearish movement, before the bullish movement, right? Then the bearish order block is the last bullish candle before the bearish movement that broke structure to the downside. Now you can see clearly that our current or the chart we have is a bearish structure. This whole chart is a bearish structure because it's creating lower highs and lower lows, so it is a bearish structure. If you support it with your trend line, you can see the trend line is what? Trending downwards. So it is a bearish trend or is a selling market. The bearish trend or is a selling market. So what you should look for here is the bearish order block, which is the bullish candle before the movement that breaks structure. And you can remember we said the structures are the highs or the lows. So for the downtrend, the structures are always the lows. This is a structure. This is a previous low. This is another structure, which is a previous low. This is another structure. This is a well-defined one. This is another structure, which is a previous low. This is another structure, which is a previous low. So these are structures. These are what we refer to as structures. A previous low for a downtrend. They are the structures. Then the opposite side is also a structure, like the previous highs, right? This is a structure. Where do I put this? This is a structure to the lower high. They are the structures. This is what is referred to as structure. Structure is just the pivot point. This place, they are the structures. So it says the bearish order block, because we are reading the downtrend, so we should look out for the bearish order block first. It's the last bullish candle that broke structure to the downside. The last bullish candle that broke structure to the downside. Now, I don't know where I said it, but I remember saying that order block, the candle color or the candle color, the candle color doesn't determine the candle color doesn't determine if the candle is a bullish one or a bearish one. Though on your chart you can use it to just differentiate them, but the candle color doesn't. It's the candle momentum that does. The momentum of the candle tells you if it is a bearish one or a bullish one. So there are some candles that, let's look at this candle. This particular candle, if you see it very well, it's a bearish candle, right? It's a bearish, it's a, should I say dragonfly or a shooting star or a doji? Yeah, it's a doji. It's a doji candle, and then it's bearish. But if you look at it very well, it has a wick. It has a very long wick. It has a very long wick, and then the body of it is very tiny. The body is looking more like a wick itself. The body is very tiny. This candle is a bullish candle because it had a lot of bullish momentum in it. It's just like shortly before it closed, that's when it came back down to become a bearish candle. So if I want to mark another block at this end, I'll mark out this as my other block because it had bullish momentum in it. That's the reason why it has a wick that is longer than the body. So it's a bullish candle. For me, it's going to be another block. And if you trace back, you see the market came back to it somewhere. So another other block is there. This is the last bullish candle before the bearish run. So you see some of them, the other blocks are not tapped into them. That is when it comes to refining other block. Sometimes the time frame you have, the other block you see is not the valid one anymore. Now this particular one invalidated one of the rules. The rules that said none should be tapped into. The other block should not be tapped into, right? If you look at this bullish candle I have, look at this place. It was tapped into. This candle brought it weak to it. The market came back into the candle. It tapped into it, so there's no imbalance. So when you go down the other time frame, you see that here was another block on the other time frame. That's why it came to tap into it. Clearly, you see this one is another block. This is another block. This is another block. This is another block. That's why the market tapped. That this is another block. So it's the last bullish candle before they ran to that broke this structure. Another one is the last bullish candle before the break of this structure. It's the last bullish candle before the break of this. It's the last bullish candle before the break of this. It's the last bullish candle here before the break of this. So those are the other blocks. Now let's look at the bullish order block. You see this particular price action is a bullish one. Price is going, creating higher highs and higher highs. This place is a bullish one. The market is trending upwards. If you support your trend line too, you can see it's going upwards. It's going upwards, right? So here we are to trade, like we are to look for buys, which is looking for bullish order block, which are what the last bearish candle before the bullish move that broke the highs. So that broke structure. So this is a defined structure. This is a structure that was broken here. These two is a structure that was broken there. You can see these two, the structure that was broken. This wasn't one. This is kind of equal highs, which is like double top and then they fake out here and then they drop. Go back to liquidity, you understand that. And here too, after the drop, it created what? A break of structure. So now the last bearish candle that caused this move is this guy. Though it's green and then it's looking like a bearish, it's from my colors from my color difference is a bullish candle, but it is another block because you see it had the bearish momentum to the downside, right? So that is the last bearish candle here that caused this break of structure. Here too, this is the last bearish candle that caused the break of this structure because this was a structure because it was creating, you see, this was a structure. It broke this one. Then it's supposed to, at first, a lot of people I know they were targeting here, but the market never respects anybody, so it does what it wants. But one thing is, it definitely will come back. It's about time. It will come back when it's time. So this is a valid order block that is still going to be mitigated in the future. That's how it is. So from here, we have this other block that broke this structure. So this is one other block. Still, the market didn't tap into this. But if you refine to the lower time frame, which I'll show you when I'm going to implement the whole strategy into analyzing the market, when I'm going to implement it with it, I think that will be the final video. When I'm implementing it, I'll show you how to do the refinement and how to get a specific order block and on the specific time frame. So here, it mitigated into one of these. I think these two can be called the order. Yeah, this because this this one has a wick inside the bearish one, so it became the order block, which was later mitigated. The second green candle is a valid order block, and then it was mitigated here. You see the market was going up. From there, it pulled back a little to tap into it again. Tapped into this one because this one is a pin bar and then it's a bullish candle, but it has the bearish momentum here. That is why it's the order block. So it's another block. So this one tapped into it. You see there, this is another order block, a bullish order block. The last bearish candle before the bullish impulse that broke the structure. This is another order block, and so on and so forth. We can see they are all very clear. Order blocks are very simple. And you see, when we talk about the entries, when we talked about the entries, we said you take the entry at the close of it, right, or at the highest point for the bullish candles. No, you take it at the highest point, bullish or bearish. Then the close of the lowest point is the stop loss. So your entries will be set like that. So when you know that the structure here is broken to the upside, you look down for the other block around here. When you see the other block, you just set your limit and wait. So when the market plays around and come to it, it will tag you in. Same here. Same with this. When the market was, after the market broke this structure, created all this bullish candle, you know that yes, it's time for it to retrace back to the other block before it continues the trend. So while the market was here already, you set your limits here and then you just leave because you know that the market will tag you in here. Your stop loss is below the the bearish, the last order block. That's where your stop loss will be, the low of it. Then it will tag you in and then see it's running in profit, right? The same thing. You just put your limit when the market breaks structure here. Put your limit here, and then it comes to tag you in at its own time. It comes to tag you in at its own time. Then rock your trends. Now your target is always the next high, or the high that brought you down to the retracement. If you take your trade here on this order block, where your first target should be, it should be on this high. The highest point it went to should be on this high. The highest point the market was before coming back to your order block, that should be your first target, because you know of the double top. At times you can go and create a double top with your high and then come against you. You understand? So your first target should be the high, because it literally have nothing to do before you reach that high. So when it impulses to that high, then you take your first profit. If it's a trend that's going to continue, you see reasons why you should hold more. Now, when we stated that order blocks are where the market makers put their money. If you notice on every other block we look at, you can see that after the other block, there's high momentum candles, and you know very well in the market, it's a lot of money that moves the candles. If you don't have a lot of money, you can't move candles with high momentum the way you can see them. So it's like a proof to you that like after another block, or after the demand or the supply, you should know that the market moves very rapidly. And when you join those kind of trend, you hit your profit within short time. That's why we love doing the day trade. So that is the bullish order block as well. So that is the end of the whole order block thing. When we get to implement all we have learned into the chart, that is when we talk about the final video. You get to see how we do it practically, and the more time you spend with us as we do the Zoom sessions, you get to understand it more as well. So it's the strategy summary. The strategy is well broken into our trading what videos. Make sure you refer to them for proper understanding. It's just read through, you get to understand. Then it says always work hard. That is just work. You need to put in time. You need to put in time. If you don't invest in time, you will not get what you need. You will not get what you need. It's not what you want, because literally what we want is for us to just rest. But what you need to succeed in this game is putting more time and hard work. So make sure you put in your time. And thanks for watching.